With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across this great country. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, October 2024. I want to start off with some shout outs. I mean, so many shout outs this week. Talked to Kevin, who was saying my next words before I could say them because he listens in all the time. And then two Jodys, one that's been with us forever, one that's brand new, both tuning in all the time. And then Margie, who I've been with Margie and Mike for over 20, almost 25 years, I guess. And Margie says, I listen to your podcast. I said, really? She says, yeah. You're going to do something about it? You're just going to stand there and bleed. Margie, that was the line of the week, the month, the year. To hear you quote from Tombstone, a alpha male cult classic like that was just too much. That was pretty awesome. And look, there's so many other folks tuning in. We appreciate you all. Can't name all of you every week, but golly day, we do appreciate everyone tuning in and using the tool to stay on top of what's going on. And then before we get into this, I have to say, thoughts and prayers are with everyone in the path of Hurricane Helene. We did reach out to everyone that we could determine was within the path of the storm. Happy to report that everyone is safe. Damaged roof. Kevin, Cheryl, we're praying for you guys out there, and some downed trees and things like that. Doug and Rhonda and others. But glad to hear everyone's safe. Just praying that you guys get through what's in front of you here and get back up and running and your feet back on the ground. But so many people are in such disarray. And not to go off the tangent here, we want to talk about money, but this is kind of appalling to me, really. I don't know if it's appalling to you folks, but the things that are going on are just horrific. And we're such a big country, and we're always there within a minute, it seems like, with planes and transport vehicles loaded with emergency supplies and food and all kinds of stuff for everyone around the world. Well, where the heck are we for our own people right now? I'm a little appalled at what I'm seeing, or not seeing, I should say. But thank goodness for the private organizations that are picking up the slack and just jumping right in. I just pray for their safety and success at reaching as many people as they can. It's quite a devastating event. So let's go ahead and jump into the numbers here. The market, wow, what a resilient market. It has been really something. It was up this week. We had the Dow Jones up barely, up 0.09. The S&P 500 up 0.2. The NASDAQ up 0.1. Russell Small Caps down 0.5%. So up, but kind of like flat across the board, up just a little bit. But what was really surprised me was all the negativity the market was facing this week. We've got Israel and Iran heating up substantially. Hurricane Helene. Unfortunately, I don't want to put a weird spin on this, but many times natural disasters, major storms, things like that actually end up being a bit of a boost to the economy because of reconstruction efforts and things like that. That said, there's some real concerns with this one because so many people lost their homes due to flooding that did not have flood insurance because they were not in a flood zone, right? This flooding was so profound and so exorbitant that it reached homes that didn't realize they needed it or should have it. And therefore, they're not covered, and there's going to be a real difficult road to navigate for these folks. I'm not sure what that's going to look like for the economy moving forward. I don't think it's going to be quite like some of the other storms of the past. So you got Helene, you got Israel and Iran, then the longshoremen, and I'm sorry I didn't really talk about this last week, I should have, but the longshoremen did go on strike, and the ports were shut down along the eastern seaboard and the Gulf Coast. Thank goodness it was only shut down for a couple of days, and they have since decided to delay the strike until the beginning of January. And I say thank goodness because there's so much that comes into these ports that's going to be needed along the path of the hurricane. So I'm glad that they have come to a decision to at least delay this action. I was surprised to hear it because the guy running this union, I mean, when you start saying things like, give us what we want or we will bury you, talking about the country, we'll bury you. Those are not nice things to say, man. You're not winning any point or scoring any points to me. I can tell you that. But look, it came to a quick close for now. So the market had a lot to deal with. And then we had some economic data. Service numbers were really, really good, really strong, kind of like a blowout number there. And then the employment numbers today, the jobs number was a blowout versus expectations. Economists were expecting about 150,000 jobs created, and the report was 250,000. I believe the unemployment ticked down by 0.1%. Now, it all sounds great, but just remember, it was a couple months ago we were told that 850,000 jobs that were created last year, that were reported to be created last year, actually were not 800,000. Who knows what the number is anymore? I don't even know. But let's assume it's correct. Let's assume it's true. 250,000 is pretty good and a little bit of a surprise to the market. Now, all of that said, the market rebounded pretty strong today. It was negative during the week, but let me tell you, it really wasn't that negative. It wasn't as negative as I expected to see it, given the oil spiking with Israel and Iran, given the longshoreman strike, given all the things that we were contending with. The market held in just exceptionally well, too well, really. I find it odd. I don't know what to say, except that I find it odd. So here we are, finishing the week strong because the jobs number. Right now, I'm hearing all kinds of terminology being bantered about my industry. Goldilocks, everything is just perfect. You got inflation coming down, employment staying strong, et cetera, et cetera, et cetera. And Fed's cutting rates. This is like the perfect scenario and all these great things. Well, yes, it looks that way maybe for a minute, but you have to keep in mind, employment numbers are the last thing to crack. They are the last thing to go down when you're heading into any sort of slowdown or recession. So I don't really hang on to this employment data as like the end all be all as to how things stand at any given moment, because that is the last thing to break. Employers are the last thing they'll do is let people go. And therefore, those things are a lagging indicator. And it's well known in my industry that employment's a lagging indicator. But for whatever reason, everyone is salivating over it. That's great. I hope it continues, right? Hey, I want to continue making more money with the market. I hope it is Goldilocks and the soft landing. It's all great. And we're all holding hands singing Kumbaya. And everything is just wonderful all next year. I just don't, I'm sorry. I've been doing this for too long. And I see too many cracks that make me think that we don't want to just jump wholeheartedly on that bandwagon. I think the important thing that we do now, and I'll talk more about this in our year end or 2025 year outlook, I'll talk in more detail about my expectations for 2025 into 2026 and how we're going to manage things. But long and short of it is we're going to maintain a really measured and disciplined approach right now. I think that's a prudent thing to do. I tell you something else. If this employment number really is legit, if things really are as strong as are being suggested, there's another thing no one's really talking about that we better watch out for. That would be a resurgence of inflation. Look, it happened back in the 70s into the 80s, and it was ugly. It was brutal. I can't even begin to tell you how bad it was. Of course, maybe you lived through it. If you did, you remember 12% mortgages, 13% mortgages, 20% car loans. You remember those times. So we have got to be kind of careful to thread this needle. And I noticed today the bond market really took a bit of a hit, right? Employment number was strong. Bond market took a hit because the bond market now is saying, well, gee, maybe the Fed's not going to be cutting rates as much as we thought just 2 weeks ago. And I would agree with that, Mr. Market. I think that you better slow your roll there if you think you're going to get 0.5 point cuts every time they meet, because I don't think that's going to be the case if things continue to look like they do at the moment. There's a fear of inflation resurgence, which we have to watch out for. Looking at the sectors this week, kind of a mixed bag across the board. Energy, as you might expect, was up the most, up 6.8% on the week, mainly because of the tensions in the Middle East. Financials were up 1.1%. That's interest rate activity there. Utilities up 1.1%, also related to interest rates. Consumer staples, defensive down 1.8%. Technology, which is a little more growth oriented, was flat. So I don't know. The market didn't really say a whole heck of a lot. It did respond a bit to this interest rate dynamic today. And that was mainly based off of what's going on with the jobs number. Okay. So again, bonds took a bit of a hit. And listen, we've been looking for some stuff to buy. We thought that maybe October would be a volatile month, and it looks like there's still plenty of weakness there. So I don't think we're out of the woods by any stretch of the imagination. And if we get a good downturn in the market, we've got a little cash on hand that we can do some buying. If we don't, look, bonds are starting to look attractive. Some of these bond investments that we're involved in are down a little bit here over the past week or so, 1.5% or so. Yields are starting to climb back up again. And we may want to allocate a little bit more that direction. We were going to wait till January, maybe January or February into next year. But hey, look, we're going to take the opportunities wherever they come. They're going to come in the form of bonds. We're going to jump on them. Look, if we can get 5 to 8%, then we're going to take it if that looks like the best thing to put our money in at the time. So look, I'm going to go ahead and wrap up. There's a lot going on out there. Market really got through it exceptionally well, almost too exceptionally. Bothers me a little bit. I just don't trust it. Kind of reminds me of COVID. All the news was coming out of China. I was talking to my contacts in China, hearing all this bad stuff going on. The market kept rising, and we started selling because I didn't trust it. I don't fully trust what's happened this past week and a half. I think there's probably still some downside here in the short. Nothing major, but I still think there's probably some downside. We'll see. Either way, we're pretty well covered. We've got all of our bases covered, diversified very nicely. We'll handle it as it comes our way. So between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's retire a little early. We had a couple of clients reducing their retirement age this week. Maybe it's take that big trip, pay for that wedding, be that rich aunt or uncle that takes care of your family when you're gone. You know what your goals are, what legacy you want to leave. Don't just think about it. Think big, think BIG, and I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.